name is Philip Kostel from University of Central Lancashire, and I'm chairing this particular session. It's a session of our regular seminars at the UK FinTrade research projects that we have been holding in public engagement or academic kind of proceedings quite regularly since last year. And today, we will have a presentation that will be presented by Pradashi, but it is a discussion paper that is joint work with a couple of colleagues like Professor Sachin, CD, and Sukmani. Sorry for my delay. But basically, it is Pradashi who will be presenting the whole thing, and we'll proceed in the usual matter. We will have like 25-30 minute presentation followed by plenty of time, about 20 minutes for questions and so on. So if you have a question, raise your hand, write the thing into the normal kind of chat, and we will be able to hopefully produce our usual kind of lively discussion. So without much further ado, I'm not going to beat about the bush. Pradashi, the floor is yours.
Thank you, Professor Philip, and thank you, colleagues. As we promised, this is an attempt to see what type of trends we are observing in the fintech sector and what type of alternative models of provision of fintech-based services. Idea is not to exhaust everything in one presentation, but some pattern that we see we are presenting, and some would be there in the discussion paper that we are going to put up for all of you to leave your comments soon. Next slide, please. Next slide, please. Yes. So as you see that it is not necessarily the crisis which has inspired the fintech industry to grow, but it has happened coincidentally because of the development of digital technology like AI, distributed ledger technology, blockchain, and others. So that prompted the industry to grow basically after 2008-9, and then it gradually gathered pace. During COVID-19, all different varieties of services that fintech could offer, those were tested, and its robustness, the security concerns, everything has been sort of assessed to a great extent. Even though it has grown rapidly across the world, but it's basically concentrated in the advanced economies, perhaps because of the mature financial system in those countries and a predictable legal and regulatory environment. But certainly, this is not restricted to advanced economies. The pace of growth in the emerging markets and developing economies of Asia and Africa is quite high, and this is gathering momentum. Next slide, please. If you see in terms of the ranking, this ranking has come up recently by Fintech-enabled. What they have done, they have tried to rank the countries in terms of their fintech adoption, and this is the picture that you see. That as expected, US, UK, Singapore, they are in the top 5, and then BRICS countries. BRICS countries are in the say in the 20s, like 14 to 25 range. Then you have African countries which are either 30 or beyond that type of ranking. But see the movement. The movement in Kenya is plus 11. That means the rank has elevated over time. And the same you can see for the BRICS countries like Brazil, China, India, of course, this year. I don't know what is the reason we have to study it further. Next slide, please. If you characterize the different stages of fintech development, this is by and large the situation that we sort of adapted from Arner and others. So 1866 to 1967, that was a very early phase of this thing. 86 to 2008, ATMs, chips, SWIFT, and all these retail payment, maybe cross-border payments were also become quite easy that time. But see the trend post 2018, startups have come up, innovative technologies, then digital currencies. So we are now embracing FinTech 4.0, which is post COVID-19. So InsurTech, Wealth Tech, and other segments are also witnessing rapid rise. Next slide, please. If you see in terms of the numbers, then in the 2021 first half, 98 billion of investments happened in the FinTech sector. And that registering 12.6 point increase over the past year. And the venture capitalists have invested significantly. FinTech has become a key technology platform for retail payments. Now, those who are 15 years and above, they prefer to use that as a model. High-income countries like Norway, Denmark, Finland, Sweden, they have very high FinTech adoption. Low-income countries also are registering, like Zimbabwe and Mozambique. They are also registering a faster adoption of FinTech in different sectors. Middle-income countries are there, like China, Malaysia, and others. As I said, African countries are also registering high growth, and the credit would go to M-Pesa as a beginning, as an initial what we say trigger in Kenya. Next slide, please. So if you see that technological advancement, diversification of products and services, perhaps there was a unmet demand in the financial services sector, which these FinTech platforms are offering. Industry structure itself is undergoing a change, and the growth is leading to another phase of growth. There are, of course, other factors which I'll discuss later. Let us run through the pattern part in the beginning. Next slide, please. Next slide, please. Yeah. So if you see in terms of numbers, there are 5,858 FinTech firms over this period, 2008 to 29. Banking capital market constitute 43%, real estate 24%, insurance 23%, investment management related stuff around 9%. Within banking and capital market, which is the lion's share in the FinTech segment, the payments, deposits, and lending is the dominant sub-vertical, and it is spreading all across insurance operations, peer-to-peer lending. As you can see in the right, the graph shows that how this is distributed. Next slide, please. And in terms of this graph, where numbers are suppressed, but you see the size of the box. Deposit and lending in the banking capital segment, real estate, property development management, also leasing and leasing and transaction, P&S transactions. So all these sizes of these boxes tells about what is happening within three different components of the FinTech startups. Next slide, please. Now, the numbers that you see that during 2008 to 21, 39.8% growth has happened in the banking and capital market segment. Not to be surprised, because we have started using these platforms so much. So 40% rise in, say, during this period itself signifies that how fast we are going. If you take only 2021 figures, payments have attracted 39 billion funding. And then deposit lending received somewhere around 11.9 billion. And the story is more or less same, with slight variations in the numbers and the pace of growth across different verticals of FinTech sector. Next slide, please. Now, FinTech in India is, I would say, not a very new phenomenon. It is basically happened in the last decade. But if you see the FinTech adoption index in 2019, it is 87%. And you can imagine 2019 is before COVID. So this credit goes to the FinTech, the spread of digital internet penetration, digital payment systems, the financial literacy efforts by Reserve Bank of India. There are now 4,000 odd FinTech startups. More than 70% of those are established in the last 5 years. Maybe that there was some push because of the Startup India initiative by Government of India. And 6 of the world's 100 leading fintech cities are situated in India. There are unicorns, 16 unicorns, and retail payment segment is growing at a very rapid pace. Regulatory system, as you must be reading in the newspapers, they are going slow, but they are going steady in the sense regulatory sandbox models are being experimented, and already two cohorts of projects they have tested. A third cohort will be announced soon, or they are processing it. Next slide, please. I think this is the pace of growth. Only look at the graph. It suggests that in terms of value, how much is the growth that we are experiencing in India in terms of digital payments, UPI, PPI, and IMPS. All these platforms are being preferred over the traditional payment models, and this is cutting across rural and urban sector, but mostly by the youth who feel it more easy to do it. Next slide, please. Next slide, please. And the investments, as I said, is also increasing. BFSI is banking, financial services industry. So you see that as part of the total fintech funding is growing, and that is there is the competition between the banking and the non-traditional financing institutions like fintech. Next slide, please. Here it is like payment, as I said, payment occupies 48.5% of the share in the overall funding in the last 2 years, followed by lending. Of course, financial accounting and other segments are there. Next slide, please. We have sort of tried to map it in terms of the timeline. If you see that every year something or other has happened in terms of the fintech support to the fintech system. Somewhere other system was launched, Digital India, Startup India, then launch of United Payment Interface. So all these together have sort of created the ecosystem for fintech to emerge in India, and that's probably has contributed to the maximum adoption within the country, even though a very large segment of unbanked population still exists. Unbanked in the sense the underserved population. So as I said, the slow but steady, that is clearly reflected in fact, the next slide. If you move to the next slide, you see that the latest one is that Bhim UPI is being launched in Bhutan, Nepal. There is negotiation with MOU with Singapore. So all these are also taking what we see in the national domestic economic sectors will get now linked to other countries, and cross-border payment settlements will also increase. So maybe this is going to the next slide, please. Here I would like to spend some time. Okay, this is the pattern that we observed globally and in India, and perhaps other countries are witnessing the same type of approach. But what type of regulatory structure exists? There are papers, I think if you see the latest IMF note, they have tried to see that what is the role of legal system in the fintech industry. The legal system brings predictability, because there was the traditional regulations, the way it was applied to the banks and non-banking financial institutions cannot be applied straightforward to the fintech platforms because of the technology component, the cyber security and other things. So if you see the regulatory structures, there are 3 or 4 types of approach one can see. Twin peak approach, it involves 2 different authorities playing different supervisory roles, prudential and other type of functions. These are prominently noticed in UK and France system. You have sectoral approach in Hong Kong, Kenya, US and India. Like there is a security market regulator, there is a banking regulator, pension fund regulator, insurance regulator. So idea is not to concentrate on this single authority, single regulator model. Here it is sectoral approach is basically multiple regulator model. But we still have single authority approach, which perhaps thought of to bring the synergy and economize the cost of regulation. These systems are visible in Japan, Dubai, Singapore, and other countries. Next slide, please. So what is the basis to imagine or visualize that the suitability of any approach, whether it's single regulator, multiple regulator, or a variety of these two, a combination of these two, that would depend on based on what is the basis of deciding that? Are we focusing on the outcome? If we are focusing on the outcome or the scope of the fintech industry, then it needs to be rule-based, principle-based. But if it is based on who is to be regulated, then entity or the individuals participating in that, or activities like wealth tech, digital lending, deposit, all different activities within the fintech sector, or it is based on the number of regulators. As I said, that if you want to reduce the cost of regulation as a principle, then multiple institutions will add to the staff strength, the fixed cost will increase in terms of buildings, establishment like that. So that could determine the model of regulation. Lastly, the degree of stringency or the type of response that you have. If you want to go slow in a wait and see fashion, then the approach could be different. If you go test and learn, or perhaps the regulatory sandbox model fits into test and learn kind of thing. In fact, sandbox is another approach. So this is a variety of approach one could see in the regulatory structure. Next slide, please. Now, the regulatory sandbox is now a widely accepted approach towards fintech, because what is happening in the fintech domain, the technological revolution is quite rapid and disruptive. The more you understand, more remains to understand on a real-time basis. So in that case, let us see that what type of gains we get from the regulatory sandbox and what are the drawbacks. So if you see the product viability, instead of say launching the product directly into the market, here they can test, see its scalability, and what type of safeguards they need to place for consumer. So that is one benefit. Authorities can also prevent risks and say preempt the possible spillover risks to other verticals, and like that. And compliance and monitoring documentation requirement also could be easy to understand that how to be prepared for the real launch of such products. Drawbacks should be that consumers of products or services are exposed to risks as they are under a relaxed regulatory setting. This is something which we got it, but not very sure that why such a kind of view would emerge. Maybe some more papers would clarify us. Consumer protection guidelines are there, but then the possibility of non-compensation to user continues to be there. Regulatory relaxation of non-traditional firms raise questions. But as I said, that these two sacrosanct way of making a distinction that these are drawbacks not necessarily appears to be true. It requires further examination. Next slide, please. Now, here I want to spend some time, whatever time left. Now, what is broadly emerging from the literature? These patterns, the regulatory structures, these have become now quite obvious to us to understand. But what does it imply in terms of the broader the economic narratives or the developmental consequences of these? If you see that the regional disparity exists, but then appears to be some sort of concentration in certain pockets. Within India also, if you see that the fintech systems are concentrated in National Capital Region, Bangalore, and some Mumbai and Hyderabad. So maybe that it could lead to some sort of monopoly behavior in that. I then try to analyze the fintech from the demand and supply type of narrative. So what we broadly observe, that if you want to make fintech revolution, it can be characterized as a seamless interaction between the conventional model of supply of banking and financial services and the fintech platforms, not necessarily one substituting for the other. Now, what the literature says, very recently 2-3 papers have come they try to see that whether fintech firms are actually a threat to the business models of traditional banking firms. That does not seem to be overarching finding in all the papers. Like if you said chew, chain, chew, and chew, a paper is forthcoming. They are saying that they have empirically established that these are basically complementary to each other. Fintech firms are not targeting what traditional banks were doing. Rather, they are looking for the underserved segments where their outreach is maximum and they could process the information and offer customized services. Uh, Fintech firms are also seen as different from the traditional banking firms in the sense that the borrowers could access low price credit from fintech firms, which they were not able to get from the banking. It's because the credit risk assessment by or the credit worthiness by the banks follow a different model where the borrowers declare their financial particulars in a physical format, and the banks do not have certain non-traditional financial information like the intensity of the credit card transactions, the history of their say borrowing in other platforms which are not accessible because the aggregators, neobanks provide that information easily to fintech firms. So fintech firms somewhere also with a high interest they can reach to the particularly in the personal banking segments. So that the kind of model one observed. So not necessarily they are competitors. In fact, banks have started adopting the fintech platforms as partners in the provision of services. If you see that is happening, so three factors broadly govern the fintech from the demand supply perspective. One, from the supplier side, suppliers are facing a possibility of cost reduction and faster processing because digital information in the form of know your customer, aggregators data are handy to them. For the consumers, they are getting these services at a lower cost, hassle free. They don't have to visit any branch, and they have started believing and trusting, and the reliability of the fintech service providers is growing. So that is providing a congenial environment for the fintech to grow. Predictable legal frameworks are gradually emerging because all the countries have started studying the regulatory implications of the fintech industry. If we see a smooth transition is happening in the production and consumption basket of financial services, shift of some segments from traditional suppliers such as personalized financial solutions, retail payments to fintech platforms on the ground of ease, low cost is happening, but still I'm not fully convinced about that low cost is actually driving fintechs to grow. It could still be an illusion unless established empirically. But I remember in one of our meetings, Professor Arun mentioned that over 130 years, US, the cost of intermediation has not declined, it has remained at 2%. That is not a case in case of fintech. Fintech, the cost of provision of financial services is going down gradually. So on this low cost part, we need to do more work rather than believing that the low cost is the dominant factor attracting people to opt for fintech platforms. Can we go to the next slide? Now, there are two divergent school of thought. As I said, that fintech, I think I have covered this much. There is a paradigm shift in. We can go to the next slide. Now, before I explain you this slide, I'm just sharing some numbers that what type of share the fintechs have in the global lending market. As per the 2019 data, this I have got from the World Development Report 2022. 5.8% of the credit stock in Kenya is actually by fintechs. This is 2% in China, 1.1% in Indonesia, less than 1% in major markets. So imagine we are at 2 or less than 2. This is the share of fintech in the total credit stock. And if you take into account the alternative financial providers, those who are not banks, they represent less than 1% of credit flows worldwide. So what does it indicate? That 98% potential still exists for the alternative finance provider to come into the industry. They may compete with the banks or may create complementary roles for them. So disaggregation, reconfiguration, all these are happening at a rapid pace. Now, what about the quality of regulatory support and capacity? They are determining the investment decisions. Fintech firms actually have increased the access to lending by the SME firms, and then peer-to-peer platforms, not necessarily emerging as competitors. They are substitutes in some way, but in certain sectors they are actually cooperating. There is a paper whether fintech firms add to the financial stability risks, but it is not actually the case. Maybe in future when we see what is happening, but that there are some concerns in the risk sector that risks may amplify because there is not proper regulatory system in place to assess how each fintech startups are actually complicating the risk assessment infrastructure and the mechanism to mitigate those risks. Next slide, please. Here, as I said, if you see Abasi and et al., this is a very fresh paper, a very interesting empirical exercise they have done. And they have come up with this finding that SMEs' access to working capital has increased. Now, last slide of our presentation is fintech and development. So this point actually should go there, where you see that the credit access to working capital is restricted for SMEs, because SMEs, the papers that needs to be submitted, that would present a very high perceived risk to the bankers, so they would not finance it. Fintechs, so that way is helpful. Fintech contributes to financial inclusion. We know that how in India the other based system, Jan Dhan accounts and others are facilitating that. M-Pesa initiative from Kenya is an example. So this fintech innovation manifested in different platforms like e-commerce for trading, say Bheem, Aadhaar, UPI as retail payment platform in India. There could be retail payment platforms in UK. So all these are facilitating a seamless adoption of fintech across sectors, and this has consequences both for the way traditional financial institutions were lending and offering the financial services, and developing countries can nurture this platform for achieving certain socio-economic development goals like financial inclusion and sustainable development goals. So this is broadly the message from the paper. But as I promised, that the detailed writing, in terms of writing of the paper, it will be presented to all of you very soon. So with this, I stop here and would very much like to respond to your queries on whatever way I can clarify on behalf of the team to you. Thank you so much.
Thanks a lot, Pradeshi, for the insightful presentation. So now I will open the floor for any kind of questions. I can see the list of participants, and there are not so many of you, so I will say it's probably easier to ask them in person. So please raise your hand if you have any question, comment, or anything. Well, I don't see anything at the moment. So to give everybody the opportunity to think about it, I will ask a question. So you mentioned the reason that one of the main driver for fintech in India in particular, in many developing countries, has been the motivation of lowering costs, which is one of the two things. It exists everywhere and so on. But in many developed countries, another motivation like convenience, particularly aiming at the millennials generation and so on, which like technology and so on, has been put, which doesn't necessarily, which is like an added cost service, not necessarily reducing the cost and so on. So one of the reasons I think why this has been driven in India is because of a large underserved segment of the population, where by providing them services and so on, you can get this extra thing. But another reason is the way it has been regulated. So new banks cannot obtain their own license, unlike, say, in the UK. So they have to use the operating licenses of existing banks. And therefore, any kind of services they provide cannot directly compete with the bank which you are begging for their license and so on. And therefore, they need to provide complementary kind of service. So this is kind of the one of the reasons. But then one issue that is created to this, on one hand, increasing financial inclusions will increase the stability of the system, financial system in general. But if you have a downturn in the economy, like the financial crisis, even like shocks caused by COVID and so on, then these underserved segments of the population, where you have very low cost and so on, are the ones that are most vulnerable to such kind of shocks, which basically means such shocks will affect too much, disproportionately, the low-cost services and so on. And therefore, they need, the one way out of this is they need to diversify. Like in India, for example, the UPI is a very low cost. No fintech can survive focusing only on UPI services. They just cannot meet their cost. They need to do something else. So are there any kind of offshoots, any evidence for such kind of diversification? Sorry for the lengthy question.
Should I maybe a couple of questions, or I can respond now?
Yeah. Yeah. So I can see. Yeah. Let's collect a few more. So I have Aaron has a question.
Yeah. I think Sherry raised her hand before me. Sherry, do you want to go first?
No, that's fine, Aaron.
Okay, okay, thank you. Thanks, Sherry. No, I think my query is about that index which you mentioned earlier. Because if I remember rightly, Reggie has mentioned in his presentation some time back about a higher financial adoption rate for India compared to many countries. So in this one, India's position is actually in the second half of that one. So what I'm wondering is, this has happened in some other areas as well. Most of these indexes are actually based on self-reporting by companies. So this is an exclusive list of companies which are actually engaged in self-reporting with the firm, or is it the accurate reflection of the whole fintechs in the country? So I got confused between adoption and the current status of that. Thank you. Thanks.
And now Sherry.
Yeah, so I've got two categories of questions. First, of course, is the UPI and the success of trying to integrate the payments systems and making it online. The greatest thrust of fintech services really is in the payments regime. I mean, can't get away from that. Of how to make more advantageous of more convenient payments and less costly. But of course, when you move into the cryptocurrency world or the blockchain world, it then requires very, very specialist regulatory framework because it's private money. Whereas if it is running on the existing bank deposit money, and then it's just convenience yield, like using card-based payments or mobile payments or whatever, that's a different kettle of fish. Coming to the second type of question is about regulation itself. I liked Priyadarshini's, the slide which showed us, there are many ways you could skin that cat, in the sense that, are you regulating the end user? Are you regulating the structure? So, or are you regulating the cybersecurity of it? Each of these things require different principles. So you said it's a rule-based or principle-based. I would like you to elaborate more on that. Okay.
All right, now we collected quite a lot of questions, but I will take another one from Victor, and then hopefully Priyadarshini wouldn't have forgotten everything and can answer this. So Victor.
Priyadarshini, thank you very much. Very interesting presentation and broad coverage of issues. Every aspect of your presentation is absolutely interesting. Because you are capturing a lot about the dynamics. I think there is also an attempt to get an explanation of why the diffusion is different across regions, and these are interesting issues. My question possibly is a question to myself as well as yourself and maybe other members, because I've been thinking about trying to look into the finance theory or the economics theory that can be used to explain the differences in the fusion of fintech, across countries and across the region. And we know we already have this problem of the technology divide between north and south, and whether this is also reflected in fintech. And I was thinking mainly maybe drawing from the theory on economic frictions, which tries to explain the perpetuation of information asymmetries, which may affect the information exchange, and also either increases transaction costs. And I don't know whether you have had some other insights in terms of the theory that we may invoke to be able to study, for example, the speed of diffusion and why the diffusion differences, or even to address some of the issues you raise here, as for example, when you are trying to look at the factors driving a rapid expansion of fintech, what kind of economic theory or finance theory may be used. So some ideas on your thinking on this might be helpful, or even indeed any other member of the group. Yeah. Thank you.
Maybe I'll respond now, Professor Philip.
Yeah. You have too much.
Yeah, referring to your question in the beginning, cost versus convenience. I think I did mention that, I fully agree with you, that low cost may not necessarily be, not only in the developed countries, globally this needs further work, empirical work. Now what is happening in India, it may not be low cost, it is convenience. Every bank branch would be flooded with people at 10 o'clock for clearing demand draft, for paying some college fees, or filling up some forms for some competitive exams for recruitment. We have seen all these in our college days and all the. Now, convenience could be a dominant factor driving fintech adoption in India and other countries than the cost, because I am not pretty sure how much of awareness among the users of fintech about the cost component. A very little financially literate segment also, if you classify them, those who are the elite financial literate, if you put it as a category so-called, perhaps they could be cost conscious, but that is not a settled debate. Even though we have papers, I'm saying that I am not fully convinced about the cost criteria. Convenience for sure is driving fintech adoption. Now, in this context, I'm answering Professor Arun's question, that whether the 87% adoption rate in India is reflecting a self-reporting by the fintech startups, or this is actually truth. Unfortunately, the construction of this index, I have not gone through the methodology. But now that we have raised, I brought it before for our project. Rather than for my presentation, I brought it for all of us to think that if that is the case, what are the factors which could explain this differential performance among the countries? Now, you saw Singapore, US, UK falling 1 to 5, and then BRICS countries and other emerging markets between 10 to 15 to 25 within that range, and African countries are after 30. If that is a broad pattern emerging, what explains this? So I'll go through it, and if necessary, I'll share that paper with all of you. But certainly, self-reporting or any other way of so adoption may be different, Professor Arun, it seems, because if adoption is 87%, then India falling at 23 is not the reflection of that type of trend. So we will study that. The financial stability concerns, I think you explained, Professor Philip, that the most vulnerable segments of the population, which have a low level of financial literacy. I'm talking about the average developing country. They are only enjoying the benefits of mobile payment services, and this is exactly true what we experienced in Kenya. Kenya, the roads are not there, formal banking systems are not there, but mobile-based payment services are there. Only that segment has grown. And that perhaps could be the only way of suggesting that the fintech adoption has increased in Kenya, not necessarily in the other segments of financial services. So this could be a very disruptive but not sustainable model of introducing fintech to the financial systems. And now coming to, I'll come to the cryptocurrency and payment part at the end, but the diffusion part which Professor Victor raised, I think you have raised a very valid question. Now, let me take you to the paper by Frost. Frost is the paper, Economic Motives Behind Fintech. This was a BIS paper in 2020. So what Frost is saying, that there could be 2-3 interrelated factors behind fintech's growth. One, driven by unmet demand for financial services, which I mentioned in the very beginning. But it could be the other way also. High cost of traditional finance must have pushed these borrowers to explore other segments. I'm telling you that Indians are ready to pay 20%, 30% rate of interest to access financial requirements on the financial contingencies, where you get the credit at 12% or 11% in the personal banking segment. Why there is a willingness to pay more for convenience, for less time of processing the documents and clearing it. So there is an unmet demand, but certainly the high cost of traditional finance also could. So both pull and push factor operating. Frost also attempted to see whether regulatory arbitrage is helping the fintech firms to grow. That does not necessarily be the case, because the regulatory arbitrage comes when you know what exactly the regulation required for fintech segment. The fintech regulation is still being studied by the countries, including advanced economies. So regulatory arbitrage factor could be partly true, that the relaxed regulations for fintech firms in terms of reporting, capital adequacy, and all these things perhaps make them perhaps reduce their cost of supplying the services, which banks cannot afford to do. What theory could explain this? I think, Professor Victor, you said it rightly. If you categorize these consumers, then perhaps, again, I'm thinking beyond what I have read in the literature, perhaps the low level of financial literacy coupled with poverty and the lack of the remote location of certain customers, certain fraction of customers, which are actually helping this fintech innovation to happen. The fintech firms are thinking of offering low low size credit to rural borrowers who are not necessarily very highly literate in terms of their financial literature arithmetics, but they could reach them because the traditional banking models fail to reach them. So the friction inherent in the conventional banking model, I think for India, the payment segment will continue to be the driver. UPI, Veem, and others are growing at a rapid pace. It's because this is provided as a public good by the government. The private banking sector has not invested. They have linked their accounts, or they give the option of linking the bank account to these platforms. Those who opt for this, they pay a nominal services to the. So the technology is developed as a public good. Now, if you take it as a counterfactual, provided the technology is developed by the commercial banks or the private sector banks, how much of those costs would get into the consumers to pay for that can be calculated, and then one can see whether the cost competitiveness is still maintained as far as fintech platforms are concerned. Digital currency, as far as India is concerned, they have introduced some high taxation for this as a speculative activity. So this is still very virgin area in India. We have to wait and see what is happening. So I think broadly I have responded to your queries. I would like to respond more if you have any further questions on this. Thank you.
All right. Thank you. Thank you a lot. So don't see any questions, so I'll use my parliamentary privilege to ask something. Now, if you have read what we have promised, one of the parts of the project actually is to deal with the issues with the trade and the fintech role in facilitating trade. So what I find exciting is, if you remember, we had this presentation last year where we were given kind of flavor of how in India there have been services which integrate accounting, banking, payments, and so on, which in simple terms is it is an example of distributed ledger system. Now, it may not be distributed ledger based on the Bitcoin technology on the blockchain, but still, because distributed ledger basically is a system which provides connectors between different relatively autonomous systems. What is shared could be everything, could be only parts, and so on. But this kind of example is what actually will drive future innovation in international kind of trade, because if you can integrate all the systems of, say, banking systems, all these logistic systems and so on, then international trade can flow much faster and so on. So this is, we don't have it yet. That is the problem. It's easy to analyze things that happen there, so we don't have it yet. But this is where we have the kind of the promise of fintech that hasn't happened, and technologically can happen in many different ways and so on. And there are pressures why it could happen, because companies have interest in this. If you need to diversify, if you need to do different things, and this is one example where, yeah, it's an example where in India somebody provides a value-added service. It is a value-added service. Whether we call it convenience or something else is another thing, because it's part convenience, part providing access. It's not that you reduce the cost; they don't have much other options. So, what would you? You know better the developments in India and so on. Are there any offshoots of such kind of things happening that can lead to this thing?
I think I fully agree with you. As if you see the timeline we presented, what is happening now since 2000s, just before the fintech was emerged as a buzzword, digital banking and the spread of digitalization was observed. And the youth population in India, particularly, they were, say, the mobile phone handsets were made very affordable. the rural telephony segment, which was in a brick and mortar model of telephone communication, was not, the mobile penetration was not high. So when these things started coming, the digital banking within the commercial banking segments, it started increasing, the digital banking component. And all of a sudden, maybe the Aadhaar has facilitated to some extent. To suddenly you see that there is a proliferation of retail payment platforms in basically last 5 years. Paytm, PhonePe, Amazon Pay, Google Pay, all these. Now we don't have any data to present that what market share they constitute, even though within 1% or 2% of the total credit stock they are saying. Today only I was checking this RBI data that the digital transactions are increasing at a very high rate across all platforms. So what you said, whether it's convenience or the cost part, the awareness, I'm not sure about it. Convenience for sure, that is there, but there are a couple of other things happening. It's possibly because of the exposure to the of the low and middle class population to, say, globalization, in a sense that the growing income of the middle class, they are exploring they are willing to pay for the comfort, the ease of the services they are getting. So all these factors perhaps have contributed to this type of trend emerging. And some of the initiatives by Government of India in terms of transferring the certain payments during COVID and others, also helping them to explore, if I can do it, if I get this service, can I get some more services? So perhaps that is one, and the competition between private happening. The call to the potential customers has become intense. So the information boom is helping these different service providers to reach in a very competitive way. So that all this together is happening. So it is beyond actually cost and convenience. It has a digital component. The second is the education, the rise of the middle class. That is one dimension. And then the competition with the global fintech industry, because foreign investors have started taking interest in funding the startups. Now all these together is probably the contributors to this type of rise of fintech in India.
Yeah, thank you very much, Pradeshi. So we've been running short on time and so on, but this is what happens when people are interested and want to talk. I'm tempted to close proceedings,
you
but
something
just
on trade. So Philip, you said something on trade. Trade actually, the trade part is not clear, because we have thought of visiting Gift City. Because of the third wave, we could not move. I am in touch with the people to understand that how it happens, because some theoretical understanding we have. For example, if an Indian insurance firm or a UK insurance firm jointly offer a product, so some sort of activity they must be doing here, and some sort of activity they might have shared with other countries. But how it happens, which technology they use, which part gets done by the UK partner, which part is done by India, then we can get into the trade component of that. That much detail we don't have. When we have it, then it would be scientific to comment on that.
Oh, thanks a lot. This was quite useful. And I was tempted to close proceedings because we are running out of time. But just before to ask, Aaron had his hand frantically up, but lowered it.
No, I think it's an Thanks, Philip. I think it's an observation based on what Priyadarshi said, because in the UK, the payment apps are actually not many. I think they use probably by the commercial banks, and they have the apps and people use that kind of apps. But in India, the commercial banks apps are actually not that popular, and that is why the payment apps actually came into the picture. That is one thing. And the second point I noticed about the central bank digital currency, which was mentioned in the finance minister's recent budget speech. In the UK and US, and they have been discussing about the central bank digital currency, and the UK is actually going to be implemented from 26 onwards. But in India, the government has actually announced it to run it from this year. I think one of the reasons is because of the payment apps, because the payment apps and most of the transactions, I think they have got it. And instead of the real setting, and they went for the digital setting. So it might have actually prompted the government to implement it actually within the same time. China took a long time to implement the yuan's, the temporary provision, and they are going to mainstream it from next year. So government of India is actually going to mainstream it from this current year, as per the budget speech. But I think that's mainly been facilitated by these payment apps and the performance of payment apps in the last few years. Thank you.
All right, so I think we have run out of time, basically, for technical reasons and so on. And thank you, everybody, for your lively interest and participation.